Corporate-owned life insurance sounds like something your accountant mentions. Once you nod politely, and then you both move on. But what if ignoring it is quietly costing your business hundreds of thousands of dollars in missed tax strategy? We're talking about a tool that Fortune 500 companies have used for decades to fund executive benefits, smooth succession, and park capital in a tax advantage wrapper most small business owners have never even touched. The catalyst here is simple. Businesses accumulate cash, face estate taxes, and eventually need to transfer ownership. And without a plan, the IRS becomes your largest unintended beneficiary. Corporate-owned life insurance, or COLI, steps into that gap by letting a company own and pay premiums on a policy insuring a key employee or owner, with the death benefit flowing back to the business rather than the family. Think of it like a financial Swiss Army knife that your corporation carries. It's part tax shelter, part succession plan, part key person protection, and part executive retention tool, all wrapped in a single premium check. The cash value inside a permanent COLI policy grows tax-deferred, meaning the company's money compounds without an annual tax drag, which is the corporate equivalent of finding an extra lane on the highway at rush hour. Earlier optimism around COLI was almost euphoric in the 1980s and 90s, when corporations were insuring rank-and-file employees en masse, sometimes without consent, and collecting windfalls, known rather darkly as dead peasant policies. Congress cracked down hard with the Pension Protection Act of 2006, requiring written consent from insured employees and capping tax benefits to key personnel, which is where we live today, a more regulated, more legitimate, but still powerful tool. The psychological tension for most business owners is real. Spending premium dollars inside the corporation feels counterintuitive when cash flow is already tight, and trusting an insurance product with a tax strategy attached triggers every skeptical instinct you've developed as an entrepreneur. But estate planning attorneys and CFOs who work with closely held businesses consistently point to COLI as one of the most underutilized structures available, not because it's exotic, but because most owners simply weren't introduced to it at the right moment. History shows that buy-sell agreements funded by cross-purchase or entity purchase COLI policies have rescued dozens of family businesses from forced liquidation when a founding partner died unexpectedly, because without that death benefit arriving at exactly the right moment, the surviving partners often can't afford to buy out the deceased estate at fair market value. The alternative, a fire sale of business assets, or a hostile outside buyer entering the picture, is the kind of outcome that gets discussed in cautionary tales at Chamber of Commerce dinners. COLI fits neatly into the broader arc of tax-advantaged corporate strategy, sitting alongside defined benefit plans, captive insurance, and qualified opportunity zone investments as tools that reward patience and planning over reactive decision-making. Online business communities and tax strategy forums are increasingly surfacing COLI threads, where operators share how their advisors structured policies to fund deferred compensation agreements, and the consensus is clear. The earlier you implement, the more compounding time the cash value has to work. One of the biggest misconceptions is that COLI is only for massive corporations with armies of key executives, when in reality, a two-person S corporation or a family LLC with a succession question can benefit just as meaningfully from a well-structured policy. Another myth worth bearing immediately is that the premiums are deductible. They are generally not, which sounds like a deal breaker until you realize the death benefit comes back to the corporation income tax-free under IRC Section 101A, which is a far more valuable outcome over a long time horizon. The practical lesson history offers is this: the businesses that navigate ownership transitions without chaos are almost always the ones that started the conversation about funding mechanisms at least 5 to 10 years before any transfer was anticipated. You don't buy an umbrella during the storm. You structure the COLI policy when everyone is healthy, the business is profitable, and the insured is still insurable at a reasonable rate. Position sizing matters here just as much as it does in investing. You don't overcapitalize the policy to the point where it strains operating liquidity. And you don't undercapitalize it to the point where the death benefit can't actually fund the buy-sell at current business valuation. Disciplined, unemotional structuring means revisiting the coverage amount every 3 to 5 years as your business grows. Because a policy written when the company was worth $2 million becomes dangerously inadequate when it's worth $8 million. The irony is that the very business owners who are most disciplined about reinvesting profits, managing margins, and protecting their operational downside are often the least protected against the single event, an unexpected death that could unwind everything they built in a matter of months. COLI doesn't eliminate that risk, but it converts it from an existential threat into a manageable financial transaction, which is about as close to certainty as business gets. Philosophically, the whole conversation around corporate-owned life insurance is really a conversation about how seriously you take the future of what you've built and whether you're willing to have a slightly uncomfortable planning discussion today to protect the people and the entity that depend on you tomorrow. Discipline, consistency, and right-sizing, the solution to your actual situation, will always outperform timing the market for the perfect moment to act. The beautiful thing is that you don't need to have all the answers before starting. You just need the right advisors, a current business valuation, and a willingness to sit down and model a few scenarios with someone who has done this before. Whether the policy ultimately becomes the cornerstone of your succession plan or simply a component of a broader strategy, the act of evaluating it rigorously is itself a form of preparation that serious operators don't skip. And if you're sitting there thinking your business is too small, too early stage, or too complicated for this conversation, that's exactly the thought that keeps most entrepreneurs perpetually unprepared for the transitions that are without exception coming for every single business eventually. Rational preparation isn't pessimism. It's the most optimistic thing you can do for something you've worked this hard to build. Whether you're exploring corporate-owned life insurance, planning a business succession, or simply trying to understand how ownership structures affect your long-term wealth, check out our links in the description below. We can help connect you with the right lenders, real estate investors, and contracting professionals to move your vision forward.